Hi, good afternoon. So welcome to Driving Markets. My name is Meir Wilensky, and today we're going to be talking about interest rates on business, interest rates on commercial property, interest rates on residential property, and overall how interest rates impact financial markets. Remember that I do have workshops on the 5th of June on options, and on the 16th of June, I have a beginner's workshop for people who want to trade, macroeconomics, understanding fundamentals, and getting a start in financial markets. In addition to that, obviously, I've got a podcast, I've got books on Amazon, and we've got this YouTube channel, and of course, got Instagram. And the idea is to help you become empowered, knowledgeable, understanding what is driving markets and how to become more successful overall in your trading and obviously in your business. So let's kick off and let's have a little bit of discussion on interest rates. So interest rates is a very, very interesting subject. What it is as follows, is that really it is a charge on your money. So originally, what actually happens is that banks will encourage you to deposit money with them or financial institutions in order to get a yield, to get a return on your money. So you essentially deposit money in a bank, or you buy a bond or an interest-bearing instrument, and you get paid interest, which is all great. Everything's absolutely fine until interest rates either go too high, which is bad for the economy, or too low, which is bad for the saver. Now, at the moment, interest rates globally are running at around about 4.5% to 5.5%, depending on which country you look at and which jurisdiction you look at, whether it's Canada, US, Europe, UK, more or less between 4.5% and 5%. The overall general trend on interest rates always depends on really where inflation is going and the health of the economy. So inflation is not the only determinant factor regarding interest rates. Interest rates also could be a stimulus factor in getting the economy going. For example, back in 2008, when there was the banking crisis, let's make a note of that. So it's going to be a bit of an interactive YouTube this on. So let's just put here 2008, which was a classic example of a stimulus package where interest rates were manipulated in order to get the economy going. The other time interest rates were manipulated is a long time ago. Maybe some viewers were not even born then. And we're going back over to 1990, where interest rates were high, and here interest rates were low. So interest rates themselves is a vehicle, is a tool used by the central banks. The central banks, whether it's the Bank of England, whether it's the ECB, the European Central Bank, or whether it is the Fed or the Reserve Bank of Canada, Reserve Bank of Australia, Reserve Bank of New Zealand, etc. So interest rates used as a tool and a particular weaponized item to get the economy going or control inflation. In today's environment, the biggest concern obviously is inflation. So interest rates are used to try and tame inflation. Now, it all depends what is the cause of that inflation. So you could have rising interest rates and yet inflation doesn't come down because there is a supply chain issue, which is therefore not the demand issue. The supply chain issue is causing inflation to rise, where demand could pull back according to the consumer's cash flow, and things start going up. The mortgages go up, the rent goes up, the credit card goes up, the car loans go up, and therefore there's less money in the pocket of the consumer. And that's the general idea of an interest rate driven attack on inflation, to reduce the amount of spendable income within the consumer's pocket. Sometimes works, sometimes doesn't. It has worked in the past, didn't work back in the 1970s when there was stagflation, for example. So overall, high interest rates are there to reduce the desire, reduce the demand, reduce the inclination of the consumer to go out and spend money. So rising interest rates will reduce consumer spending, generally speaking. The other area of rising interest rates which benefit the consumer or the saver is to do with bonds. So bonds will price themselves at a level that makes it attractive for the consumer or the investor to buy those bonds. And we're talking about bonds that are government bonds or corporate bonds. So the government bonds pay a yield and they pay a interest rate on that particular bond to attract traders, in fact, attract investors to come in and buy the bond and give your hard-earned money to the government, where they will spend it on whatever they see fit, whether it's welfare, social benefits, infrastructure, defense, whatever they spend the money on. Once you've given that money over to the government, or you've invested in a bond, then that money goes to the government and they will pay you interest over a year, 2 years, 5 years, 10 years, 30 years, all depends how long you hold that bond for. So interest rates can be used as an investment tool. The other area of interest rates, which obviously applies to most people, is to do with housing. And that is really an essential part of this overall lesson. We'll be discussing this on the workshops. So if you want to join the workshops, you can always just direct message me, or you can text me. My number's available. Join the Instagram, and you're on Instagram, you'll be able to send me a message. But interest rates on housing is now a big topic. Why is that? Well, the housing market has really had an impact of two things. So look at now what we're going to demonstrate. The housing market is based on demand and interest rates. But the demand is sky high, even though interest rates are up. So as demand is sky high, the reason why demand is sky high is because there has been a movement of population across the globe, from Africa, from Middle East, from Asia, and they've moved over to European countries. And therefore, European countries have seen a massive demand in the housing requirements in order to house these particular migrants. As a result of increased demand, where available housing has been taken up, then you see that the price of housing, obviously by everyone recognizes it's not something special that I'm saying, has gone up and risen. Now, in addition to that, you've also got low building, or a lower level of building completions. So not only that, you've got building completions here, which are actually overall down. Okay, so in order to satisfy the demand, what should happen normally is that the builders should get out there and build the properties. But the cost of building the properties has actually increased, and therefore it's making it less economical as far as the builders are concerned. In addition to that, there is the new people that are coming in to buy those properties could be seen to be falling away, because the interest rate that you're going to have to pay on your mortgage, which is the finance package for you to get from the lender, is going to be so high it makes it too expensive. So it's a bit of a catch-22 situation. When a situation where demand is still high, there's not a lot of inventory, and also you've got high interest rates. And therefore, when interest rates come down, which they will come down at some stage, so as interest rates fall, the price of properties will shoot up. The demand for those properties will escalate, will increase. Why? Because all that pent-up demand of people waiting to get onto the property ladder will dramatically move the property market, because interest rates coming down makes it more affordable. So where is the property market going? What really is going to happen to the property market? Well, it all depends on the state of the economy and employment. If employment was or unemployment was to rise, so if you had rising unemployment, then what would happen is you'd have people who could not afford their mortgages. So one of the threats to the property sector is unemployment. So as unemployment rises, which it will, then you're going to have a falling property sector, because what will happen is those people are not taking their paychecks home, or don't have enough money to pay the interest on, or repay the repayment program on their properties. And eventually the banks will come in and either introduce either lighter terms, or could even repossess the properties. So as unemployment rises, you'll see a fall in the property sector. And that is something that could affect the prices. On the other hand, if employment still stays as high as it is and doesn't move, then the probability is that property is going to stay as high as it is. But overall, in a developed economy like we are at the moment in the UK, US, and Europe, probability is that as unemployment rises, which it is, then you're going to see property prices fall in the residential sector. In the commercial sector, it's even worse than that. The commercial sector now has over 56% late payments. In other words, within the calendar month, they're not paying on the due date, not yet gone into defaults, but that normally falls into a default. So as defaults rise on the commercial property sector, because businesses can't afford to pay the rent on time, so now the rent is going into late payment, means that landlords who are dependent on that rent coming in order to pay their mortgage or pay their loans, then they're going to be late, and then the residential lender or the commercial lender, whichever lender it is, could end up imposing or repossessing that particular property, commercial property. So if the commercial property sector drops and there's more letting properties come onto the market, then you see the property market will drop. I personally am expected to see a 15 to 20% drop in residential properties in 2025, unless interest rates come down substantially and employment stays the same. Remember, I do have the workshops on the 5th of June, which is an interactive live Zoom workshop. It will be recorded on options. And I've got another one on 16th of June to do with all their basic beginners traders. You can always catch me on Instagram, and I've got my books on Amazon. This is Meir Wilensky with Driving Markets. I hope you enjoyed that session. Catch you later.